The last part of Unit 2 EDESE financial course is looking at interpreting financial statements as well as making comparisons of different financial statements. In doing so, we will be using the ratio analysis to make comparison so that decision users can be able to interpret the financial statement, the component of the financial statement, every item in the financial statement with the help of the ratio analysis. Therefore, the next question that we need to ask ourselves is, what is ratios, or what is ratio analysis? From our slide, we can see that ratios are comparison of more than two items in the financial statement. You can compare, for example, the current asset for last year and the current asset figure for this year, as well as their liabilities, to make an informed decision about the financial position of the company in terms of liquidity. Ratio calculations are used to measure business success or failure. Ratios allow external decision makers to assess the accounting quality reflected in the financial statement and help investors make decisions. Ratio analysis can also be used to review trends and compare profitability of entities in the financial statement. Therefore, without ratios, financial statement will be largely uninformative to all but the very skilled. That means if you are not educated or educated in accounting or financial courses, you might not be able to understand the financial statement. But with the help of the ratio analysis, every one of us can interpret a given financial statement. Let's quickly move over to the next slide and look at the ratios that we shall investigate as a result of this training. We'll be looking at the profitability ratio, the liquidity ratio, we have the efficiency ratios, the shareholders ratios. The profitability ratio measures the effectiveness of the firm's ability to generate profit given sales or its capital assets. How effective or efficient can you make profit based on the utilization of your assets and sales revenue? Examples include, under the profitability ratio, the return on capital employed, the net profit and asset turnover ratio. The next ratio we'll be looking at is the liquidity ratio. Liquidity ratio simply means the ability of the firm to pay its debt and the amount of capital available to a company. Example of ratios used under the liquidity is the current ratio, the creditors ratio, and the debtors ratio. Because of time constraints, we will therefore look at one ratio in particular in the next slide. These are formulas for calculating a ratio. Return on capital employed, known as the ROCE, is calculated as profit divided by capital employed. Profit is taken from the profit and loss account. Capital employed is taken from the balance sheet. In some cases can be calculated as the total asset or the net asset. In some situations, the capital employed can be regarded as the owner's equity times 100. The figure will tell us if the company is making profit at the short or long run. The next ratio we look at, the formula is net profit divided by sales times 100. In ensuring profitability, the net profit can be taken from the profit and loss account, and the sales figure can be taken from the profit and loss account under the sales or revenue section times 100 over 1. The figure will give us a clear picture if the company is generating enough revenue from the sales. The next ratio is looking at the asset turnover ratio, and the formula is sales divided by the non-current asset. As mentioned earlier, the sales figure is taken from the profit and the loss account, while the non-current asset is the fixed asset under the first column of the balance sheet. Therefore, the sales figure divided by the non-current asset figure will give us a clear picture of how the company is utilizing its assets to make profit. The next ratio we'll be looking at is the current ratio. Bear in mind, the current ratio is very important to any business. The ratio simply tells us the ability for the company or the firm or the business to pay or meet its short-term debt liabilities. Do you have the day-to-day requirement, financial requirement to pay your debt, to pay wages and salaries, to pay creditors and those you are owing, as well as premises? Therefore, you're looking at taking that figure from the current asset divided by the current liabilities. The current liabilities are, for example, your overdraft. Do you have enough money to meet the needs of paying back your overdraft on a monthly basis? That is the question we should be talking about. Creditors. Trade payables divided by the average credit purchases by 365 days in a year. The creditors is simply telling us how efficient are you in paying back suppliers money you owe them. How efficient are you in paying back goods purchased? And that is why we are taking the trade payable from the balance sheet figure and the average credit purchase from the trading profit and loss account divided by 2. That will give you the average credit purchases. The last ratio here is the debtor ratio. The debtor ratio is telling us ability to collect the money owed to you. How efficient are you tracking customers' payment? What are the incentives created by a business or firm to collect money owed them by their customers? A prospective investor will be looking at that figure if you can collect money for goods or product or services rendered or owed by debtors. Let's look at an example. This is a case study of Cafe Warehouse. Cafe Warehouse is a UK phone company located in the United Kingdom. Let's calculate the debtor turnover ratio. Credit control is important for business growth and survival. Therefore, look at the formula for the debtors ratio. Trade receivable divided by the average credit. So we have the turnover. We have the turnover there and the receivables. Okay, let's see what we got in there. The debtor turnover ratio for cafe and warehouse simply says that is the figure. In 2002, it took the company 49 days, 0.03 days to recover the money owed to them by their debtors, whereas in 2001 it is a bit less. Therefore, the ratio seems to have worsened by going down from 43 to 49 days over the 2 years. It means that on average, the cafe warehouse debtors are taking 1.5 months to pay the account instead of the 30 days payment policy stipulated in the UK. In the United Kingdom, payment policies for most banks overdraft is 30 days. So if you are taking 49 or 43 days to recover your money, how can you meet the deadline of the payment days? This should be a concern for management and shareholders as well. As you can see, we have been able to tell us the importance of using ratio analysis to analyze our financial statement and make an informed decision. This type of information here is what is required from all learners that are participating in this program. Therefore, we've been able to conclude our course for today. I thank you very much for listening. Hopefully, you will find other resources in the college Moodle, and as well as other links to help you perfect your skills as you progress in this training. Thank you very much. Why can't we do that tomorrow? Let's do that tomorrow.